Ron, no, you don't. You have to acknowledge it's pretty good. It's the first half of the year, at least, much better than feared, don't you think?
With respect to the economy?
Sure.
Oh, yeah, no, and Kelly, I've never suggested that we're currently in a recession. The risk is always, somewhere down the road. The yield curve isn't appropriately inverted from the 3-month to the 10-year yield, as Arturo Estrella, the person who studied this most closely, has pointed out on Twitter all day today. And yeah, the economy is still growing. Well, GDP is not in real terms, but the job market certainly is. Although our colleague Sarah Eisen pointed out in the household survey, there were 300,000 jobs lost, which accounted for the downtick in the overall workforce participation rate. So there are a few signs on the horizon. What I'm pointing out, though, is that the Federal Reserve, as it continues to raise rates, probably needs to take a look at what's happening in Europe, because they could have a very, very difficult winter that leads to a broad and deep recession that will have some repercussions outside their borders.
Well, I mean, they're in a pickle in Europe because of Russia's invasion of Ukraine and their kind of reliance on Russia as an energy supplier. So to the extent that they're left with no other option, slowing demand, i.e. through rate hikes, is one of the only options.
Well, yeah, but they've also got a double-edged problem in Europe right now, because the peripheral countries that are so heavily indebted also can't afford the higher interest rates. So they've been looking at the European Central Bank on ways to get rates up, slow demand, bring inflation down, which is higher there than it is here, but also not put Italy, Spain, Portugal, and other heavily indebted countries in a bind and create the type of crisis we saw in 2011. So, at least out of the corner of one eye, the Fed ought to be looking at this field, because I do think for Europe most definitely, there is and this is an ill-used expression, but it's a winter of discontent that is coming. And if they are diverting natural gas to homes before they send it to businesses, it's almost the equivalent of a COVID lockdown if it comes to pass that way.
So Ron, I mean, this idea, all of these things that you mentioned should be viewed as economic headwinds, not just here, but globally as well. If you look at the overall picture from your perspective, though, there's been a big discussion about whether or not markets have already kind of priced in this economic slowdown if it were to happen. I mean, recessions are inevitable. It's just a question of when. Do the markets have it correct right now? Both the bond and the stock markets, they've already sold off fairly decently in expectation, perhaps, of that slowdown.
Yeah, I'm not that worried about where we are with respect to the stock market. We've come down a lot. I mean, the average stock is down more than 30%. The NASDAQ, has gone down sharply. The meme stocks have collapsed. Speculative excesses have been effectively wrung out of the market. So I think net, a certain portion of that is a good thing. And so, yeah, the market has discounted a slowdown, or what we used to call a growth recession back in the day. I don't think the markets have discounted, a decline in corporate earnings or a full-blown recession that drives the unemployment rate to, as someone like Larry Summers, for instance, suggested, back to 5% as being a necessary precondition for inflation to fall. I don't think the market has certainly discounted anything that dramatic.